What if you could turn $10,000 into over $100,000? At the end of this, you'll have criteria to look for in an investment fund. Some strategies that are potentially effective for you, plus how to find superior funds. With this in mind, a lot of people have been searching for the SPDR Portfolio S&P 500 Growth ETF, known as SPYG. Would you like $1 million? Watch till the end, otherwise, it won't make sense how it could be possible for you to get there. The SPDR Portfolio S&P 500 Growth ETF, also known as SPYG, saw its starting balance of $10,000 grow to $36,997. The Fidelity Select Semiconductors portfolio, or FSELX, we see a striking surge. From the same $10,000 starting point, it skyrocketed to a whopping $108,566. This remarkable growth underlines its strong potential and standout performance among its peers. Meanwhile, the Schwab US Large Cap Growth ETF, abbreviated as SCHG, also performed admirably, turning its initial $10,000 into $42,173. With these numbers, FSELX shows a clear lead in growth potential. But what about yearly returns? Annual returns can make or break an investor's decision. Let's compare how our ETFs perform annually. When we delve into the compound annual growth rate, or CAGR, the figures are quite telling. The SPDR Portfolio S&P 500 Growth ETF, known as SPYG, has a CAGR of 13.98%. Meanwhile, the Fidelity Select Semiconductors portfolio, or FSELX, skyrockets at 26.93%, and the Schwab US Large Cap Growth ETF, or SCHG, holds steady at 15.48%. Turning our gaze to the pinnacle of performance, the best year metric highlights the potential of each fund during their most successful periods. SPYG saw an impressive year with a 33.47% increase. SCHG wasn't far behind with a 50.11% peak, but it was FSELX that truly dazzled, soaring to 78.14% in its best year. FSELX not only leads with the highest CAGR but also boasts the most impressive best year. However, high returns often come with higher risks. Let's assess the risks associated with these ETFs. When we dive into the world of investment, understanding risk metrics like standard deviation is crucial. For instance, the SPDR Portfolio S&P 500 Growth ETF, or SPYG, has a standard deviation of 16.49%, suggesting moderate volatility. In contrast, the Fidelity Select Semiconductors portfolio, known as FSELX, stands at 27.50%, indicating a much higher level of risk. The Schwab US Large Cap Growth ETF, or SCHG, is also in the mix with a standard deviation of 17.42%. But what about the tough times? The worst year for SPYG saw a decline of 29.41%, while FSELX dipped even lower at 35.18%. SCHG experienced a significant drop too, at 31.80%. Maximum drawdown further paints the picture of potential losses. SPYG recorded a maximum drawdown of 30.40%, FSELX faced a steep 40.74%, and SCHG saw a drop of 31.80%. While FSELX offers high returns, it also poses the greatest risk. Let's see if the risk is worth it through risk-adjusted returns. To truly gauge investment quality, one must consider risk-adjusted returns. Let's dive into the Sharpe and Sortino ratios for our three ETFs, which illuminate how each fund compensates for the risk investors take on. Starting with the Sharpe ratio, which measures the average return earned in excess of the risk-free rate per unit of volatility, the Fidelity Select Semiconductors portfolio, or FSELX, stands out with a ratio of 0.96. This is higher than both the SPDR Portfolio S&P 500 Growth ETF, known as SPYG, at 0.79, and the Schwab US Large Cap Growth ETF, or SCHG, at 0.84. Turning to the Sortino ratio, which focuses only on the downside volatility, FSELX again leads with 1.60, compared to SPYG's 1.26 and SCHG's 1.35. This suggests that FSELX not only offers higher returns but does so with a better handling of bad volatility. In terms of market correlation, SCHG mirrors the benchmark most closely, with a correlation of 1.00, followed by SPYG at 0.99 and FSELX at 0.82. This lower correlation indicates that FSELX might offer beneficial diversification away from market movements. FSELX not only leads in returns, but also in risk-adjusted performance. However, its lower market correlation suggests a different risk profile. Remember that $1 million we talked about at the beginning of the video? If you dollar cost average FSELX, he would have reached over $1 million in that same time, by dollar cost averaging $2,000 a month. That doesn't mean that performance will happen again. It just means that by looking at all these factors above, like expense ratio, using portfolio visualizer and fund screeners, you could find potentially something better out there. I noticed that Fidelity has more expensive but superior performing growth funds, while Charles Schwab has the cheapest in comparison to performance than iShares or Vanguard, which always lag behind. Look at the expense ratio and then look at the differential between returns. Are the returns of one fund consistently jumping ahead of the ones you're comparing? How long until you know that one fund is pulling ahead of the other? That's important, because if you feel like you're paying an expensive price for nothing, you're going to want to bail. Invested in the market is more important than investing, because you're already in it and opening yourself up for your investment to grow. You only get the back-testable crazy results from dollar cost averaging. YOLO trades don't work, and getting in and out will turn your account in both taxes and your emotional well-being. If you go more aggressive with volatility, you already have paid the price emotionally from the drawdowns, probably don't need more of that. Most professionals don't outperform, or they're trying to sell you the positions they don't personally want. Volatility is a hidden price you pay for outside returns. There's no getting around this principle. Use Portfolio Visualizer screening tool to find good performing funds. Fidelity also has a fund screening tool, looking over long time periods of 10 to 15 years or longer to even expect your quote returns to match or be similar to the returns in the prospectus. Plan for longer. If you need the money in a specific time frame shorter than that, you're going to set yourself up for failure. Do your own diligence and sort of financial advisor, because this is just an entertaining video on the internet and not financial advice. Subscribe and comment on what time you would like me to look into next.